Fight for Justice is brought to you by the Kia Store of Anniston and Rainbow City.
Good evening and welcome to another episode of Fight for Justice. I'd like to welcome my father Arthur back. After a few weeks off, we're ready to come back with what we hope you will find an interesting show tonight. We have a guest, Mr. Rodney Gibson. Mr. Gibson is an accountant at Warren Averett here in Anniston. And tonight we're going to talk about business formation, the tax implications for business formations and the different types of businesses one can set up, and then the liability issues that can come with those. So,
ready?
Yeah,
I haven't been gone several weeks, by the way. It was only 1 week. And in the final segment, Freeman's going to talk about how you get around corporations if you're trying to collect money from the owners. So we're going to look at it from both perspectives, the owners and the creditors. First of all, we're going to talk about the kinds of entities you can form if you're going to operate a business. And if you would put up screen number one, the schedule we have, then we're going to go through them one at a time. All right, now if you look up on your screen, you'll see the different kinds of, and these are not all of them, but these are the basic ones, and that's all we're going to talk to you about tonight to try to limit our discussion about what you can do. Now, most people, a lot of small businesses operate as a sole proprietor or as a partner, simple partnership, you and one other guy, you and two other guys, or whatever. What happens if you have a sole proprietor and a partnership? By the way, you don't have to have any of this in writing. You can with a partnership, you can have a partnership agreement. But a sole proprietor, there is no writing needed because you're it. What happens if you operate as a sole proprietor? You are personally responsible for the debts and liabilities of your business. You're personally responsible for any actions by anybody who works for you, who gets into, say, a car wreck or signs maybe a debt obligation that you gave them authority to do. And there's often a dispute about whether you have that authority or not. We go down to B and we say, how can you protect yourself from those kind of liabilities? Well, you have to form an entity. These are two of them. There are others, as I mentioned a minute ago, but we're going to deal with the ones that are most common. A limited liability company, better known as an LLC, and a corporation are used by the simple INC. Now, how do you form that? And you can come on back. You can take that one off. Yeah, thank you. A limited liability, there's a statutory creation. You have to file organizations of the LLC. And it has certain things in there which we're not going to go into tonight, but you have to do that. You have to now register the name of your LLC with the Secretary of State of Alabama, and you do that in advance. And then you have to decide, who all is going to be in this LLC. You can have a one-person LLC, or you can have as many as you want. That's not true with what's called a sub S. I think you're limited to 75, aren't you?
That is correct, Arthur, yeah.
Yeah, we'll talk about that in a minute. So these are the ways that you can limit your liability. I said limit, I didn't say exclusive or prevent any liability from happening. The liability issues come up kind of in two ways. One is the debts that the company owes, and the other is because of some accidents that occurred and they want to get back at the company for a wreck, let's say. Give you an example. Let's suppose that you're in a business. You have to buy inventory, you have to buy supplies, and you may do it with debt. You may sign off on an invoice. It creates a debt. So if you don't pay that debt, what happens, Freeman, if you don't pay that debt?
You're going to get a call from a collection agency.
Yeah.
And if they can't collect the debt, then they're going to sue you.
Yeah, somebody's going to sue you, and they're going to sue who are they going to sue? Let's just go through it.
Well, if it's a sole proprietorship or a partnership, they're going to sue the individuals. If it's an LLC, they'll sue the LLC. If it's a corporation, they'll sue the corporation.
Now that's the reason you form these entities, so they can't ordinarily get to you. There are ways to do that, and we're going to talk about that in a minute. So, Rodney, what do you think is the most the worst kind of shield that you can get between these two?
Well, the worst kind of shield obviously is the sole proprietorship or the partnership, because there is no shield. So when you talk about the limited liability companies or the corporations, the limited liability company is typically a lot more advantageous and it doesn't have any restrictions. Restrictions such as number of shareholders. The operating agreement can basically be anything you want it to be as long as it's agreed to by the partners, the members of the LLC. In a corporation, a little bit more formal, required minutes, shareholders, board of directors, officers of the corporation, all these things have to be elected typically on an annual basis. Sometimes it's not done on an annual basis, sometimes it's done on a haphazard basis, but when you do it on a haphazard basis, everything with a corporation is a little bit more formal than it is with an LLC.
You mentioned the operating agreement, and I need to tell our audience what we're talking about there. If you're a sole proprietorship or a partnership, you operate by your own rules. In a partnership, you can have rules in writing. But if you're a sole proprietorship, you don't have to have any rules in writing. You just do it as you please. In an LLC, it's more formal, as Rodney pointed out. You are governed by what's known as an operating agreement. Now, if you're a one-person LLC, which you can be, you don't have to have an operating agreement. Doesn't matter.
Some banks will require it to set up an account.
That's true.
But if you're, generally speaking, if you're by yourself, it's not necessary.
You don't have to have one, although it's an indication that you're doing business in a proper way if you do have one. And the operating agreement lays out who's in charge, who can do what, who can't do what. If you have two or more people, it's always advisable to have an operating agreement. And it's like the bylaws in a corporation. So an operating agreement, Rodney, is the document that tells you how the LLC is governed.
That's
right?
correct. That is correct, Arthur. Typically, the operating agreement does several things. It tells how a member is admitted to the organization. If there's disputes, it tells how disputes are solved. If a member so wants to exit the organization, it tells how that person can exit the organization methodically in accordance with the operating agreement. Lots of times in LLCs, if there is a disagreement, it's usually when there's not an operating agreement, which is ill-advisable, and typically any disputes that come up in the organization are typically look to the operating agreement to solve those disputes.
Yeah, let me mention one quick thing before we have to go to our second segment. But that's when you get married, when you form a business relationship. But the day is going to come when you're going to be divorcing each other. And what's the document you need to look forward to that problem?
That's right. It's an operating agreement.
Buy-sell agreements.
Yeah, buy-sell agreements and operating agreements typically tell that.
Okay. Well, in the second segment, that's what you're looking at. You need to form one of those two. You don't need to stay a sole proprietorship. We'll see you back in a couple of minutes with our second segment dealing with taxes and liability issues. Welcome back to our second segment of our show tonight. We're talking about what kind of business entities you can form to protect yourself. All three of us agree that you should form an LLC, preferably in a corporation secondarily, and you should not operate as a sole proprietor, or maybe not even as a general partnership. You have too many issues and problems you can get into. So we're going to carry on this segment talking about the liability and tax issues of the different forms of business entities. If you'll put up schedule number 2, and I'm going to ask you, Rodney, to chime in here when we get that up. What we've got here on the screen is an outline of tax and liabilities for the different types of entities that you may have. All right, Rodney, we start out with sole proprietor. Who pays their taxes?
The sole proprietor. The person forming that entity is the person that's going to pay the tax. And it's typically the easiest form of business to set up, but it's also the most risky. Because if anything goes wrong, it falls back to the owner of that entity that's going to suffer the liability. And
on the question of debts of the company or the sole proprietorship or accidents which happen, which may make the company or entity or the sole proprietor liable, who's responsible for that, Freeman?
Well, the owners would be.
No protection.
They have no protection. Someone can come after them personally for any debts or any liability issues. If they were to hit somebody in their truck, that could cause problems for them personally. And also, Arthur, the taxes are going to pass solely to that individual.
Yeah. Okay, and on a partnership, we have the same answer. Owner's taxed, pays the taxes, and he's personally responsible for the liability of the company.
That's correct.
Now, we go to the LLC. What happens there? It changes, doesn't it? Rodney, comment on the taxes.
It does. On an LLC, it's typically, from tax standpoint, it's taxed as a partnership, just as a normal partnership would be, but it's a little bit more formal. And like Arthur and Freeman said, there has the ability of having limited liability. From a tax standpoint, the tax attributes of the LLC are passed through to the members, which is good because there's no entity level tax that the entity would incur itself. The taxation passes through to the individuals. There's different tax aspects of the LLC that pass through differently for an individual, such as if the LLC makes contributions, charitable contributions, the tax attribute of that contribution passes through the individual.
The owner gets the credit for it.
That's correct. The owner gets the credit for it.
But the LLC doesn't pay any taxes at all.
That's correct. The only tax imposed on an LLC are payroll taxes that you would normally have under any employment situation, and also a privilege tax. There is a privilege tax in the state of Alabama. It's typically based on the capital employed in that entity, but the minimum fee is $100, and that's the fee our great state charges an entity.
Let's look at the corporations, better known as incorporated. When you see that following the name of the entity, it means it's incorporated, or it should indicate that. That entity pays a tax, doesn't it, Rodney?
It is. Typically, well, there's two options. You have a C Corp and an S Corp. On a C Corp, which is your normal type corporation when you're referring to a corporation, has an entity level tax on all profits. And the only way the owner can get the profits out is through a dividend.
Raise his salary.
Raise his salary, which is a deduction to the corporation, or pay a dividend.
Yeah.
And in the case of a dividend, you're not only paid corporate level tax, but there's also a tax on the dividend under capital gains rates at 20% federal, 5% state.
Freeman, comment about the owner's liability for debts and for accidents that may occur in the operation of the company.
You're shielded to a degree. That the only way to get through an LLC or a corporation would be to what's called to pierce the corporate veil, which we'll go to in greater detail in the final segment tonight.
Now, there's some exceptions to this that I put in a footnote to that chart about whether owners can be liable or not for debts and so on. One is that your creditor makes you personally guarantee the debt, or another one would be where you negligently entrust a vehicle to an employee. You could be hit for that.
I think it's important to note also the negligent entrustment, that you can be held liable for that as an individual who, if you know someone who's got a horrible driving record and a lot of DUIs or a lot of speeding tickets, and you give them your car and they go and hit somebody, you can be held liable for that.
Or you don't disclose the company exists and they think they're just dealing with you. Okay, you can take that slide down now. And next we're going to make a short comparison here of LLCs and corporations, because we think that's the most favored method of forming a business and one you should use. First, let's start with a limited liability company, and better known as an LLC. Do you have limited liability, Freeman, in an LLC?
You do.
Which means that ordinarily you're not responsible for debts or accidents of an LLC. How about the corporation? Do you have limited liability?
It's the same with regards to liability.
But remember, as Rodney pointed out, one of the big differences with a corporation is if it has any profits, it pays taxes. Then if it passes out dividends, you pay taxes a second time on the dividends. That's a big disadvantage.
That's correct. And really, Arthur, too, one thing that often gets overlooked in these entities, and any entity when you're dealing about, you talked about entrustment, entrusting an employee to a car, there's also another type of entrustment in these type entities, and that's what they call the trust fund liability for payroll taxes.
Yeah, you can personally be held responsible
That's correct.
for that,
And
even
an owner,
though you're a business.
in any of these entities will be held personally liable if they do not pay the trust fund portion of those taxes.
Uncle Sam always has a way to get you. So it doesn't help you to be an LLC or corporation with that respect.
That's correct.
Now let's talk. You don't have to put the chart back up. Oh, okay, that's okay. On the management in an LLC, it's managed by its members. It doesn't have stockholders. It has members, and it has a manager, or the members themselves can be the managers. That's who runs it. In a corporation, it has a board of directors who appoint officers of the corporation. Stockholders elect the board, and the board appoints the officers who run the day-to-day operation. The ownership of an LLC quickly is the members, and that's whether it's one person or 5 people, it can be his number that you want to go into business with. In a corporation, you have stockholders. Again, you can have a one-person stockholder, or you can have as many as you want to get, unless it's a sub-S and you're limited to 75. He's on the 4th line. It says governors, but it really means governance. How do you govern the different entities? With an LLC, you have to have an operating agreement, or should have one. and you have managers who goes by those. And if the operating agreement doesn't cover everything, there are statutes in Alabama which supply the rules under which you have to operate an LLC. The same thing is true with the corporations. You have bylaws which control how things are to be run, how you elect officers, and so on. So you have both of that, and they're just called by different names. Now, when you have an issue, as I mentioned a minute ago, when you get into business, everybody is happy. It's a marriage of kind between business people, just like a marriage between humans. It works out in Alabama. 40% of our marriages end up in divorce. In corporate ownership, all of them, sooner or later, are going to end up in some kind of splitting of the sheets. They're going to go their separate ways. And the safest way you can avoid trouble is to have a buy-sell agreement, which will tell you under what conditions you're going to divide, how you're going to divide the assets, and how you're going to price those assets. If you don't have one, you're in for a court battle, which could get expensive. Now, we like that, but you may not like it, so we recommend you have a buy-sell agreement with whoever your partners are, and that's the best way you can operate it. Okay, we have about a minute left in this segment. Rodney, anything you want to add to the tax issues between LLC and corporations?
Well, mainly just point out, Arthur, again, the difference between the taxation on a corporation and in the sense of a C corporation. C corporation has double taxation. You got the corporate level tax.
Let me interrupt you.
Sure.
Some people may not know what the word C means. It's just an IRS designation of what kind of corporation you have.
That's right. Corporations are formed at the state level. All corporations are corporations, and then you have an election that you can make before the IRS as an S corp.
Okay, we're about to end this segment. We want you to, in the next segment, we're going to tell you about future shows that we got coming up. Some of them will be pretty darn interesting. But in the third segment, we're going to talk about how you get over that hump of the LLC and the corporation if you're trying to collect a debt or some liability. And Freeman's going to educate us on that. So we see you back in a couple of minutes. All right, welcome back to our third and final segment. First thing, we want to thank two of our main sponsors, Kia, here in Anniston. And out of full disclosure, I have something to do with Kia, but we thank them for helping pay the bill here. And to Miller Sand and Gravel. They also are a sponsor of this show. In the future, we're going to have a couple of interesting shows. We hope you'll stay tuned. In 2 weeks, I know we're having a trucking expert who's been with the federal government for years and now testifies in a lot of litigation cases involving trucking accidents. And you'll learn about how tightly controlled the trucking industry is by the federal government. And then, Freeman, you're going to have a couple of guests. Tell us about those.
We have a show coming up that I hope you guys will enjoy a lot. One of them is going to deal with hip replacements and some litigation that is ongoing with the supplier of those hips or some of those hips. There's a lot of different suppliers, but one in particular that is the subject of a lot of litigation. And then we're going to have a couple of my good friends from Montgomery up to talk about criminal law and criminal law as it deals with some politicians and political actions as well. And I think you guys will enjoy both of those a lot. Well,
they're the ESPYs, and they defended the owner of some casinos in Montgomery and some of the surrounding counties. Ended in an acquittal, so they'll be able to talk about the innards workings of that case.
And governors as well.
Governors as well, yeah. They've had some big ones in Montgomery, and that's where the action often is. In political cases, they're all about politics. Anyway, stay tuned for our future shows and watch both of those. They should be really interesting. Our third subject tonight is, and we're going to look at it from both sides. Let's suppose that you're a creditor of an LLC or a corporation, and the corporation is out of business, has no assets, and you can't collect your money. Do you have any alternative remedy or thing you can do to collect your money? The answer is yes. Freeman's going to talk about that. Same thing is true, and this happens a lot. You sue some company that's a corporation or an LLC, and guess what? They're out of business. They don't have any assets to collect. You have to go after those assets to try to collect your judgment. They have no insurance. That's even worse. Is there anything else you can do against that corporation to try to collect what's owed to you or been determined to be what's owed to you? Their answer is yes. Generally, in the legal world, we call that piercing the corporate veil. That means you're able to get through the corporation right back to the owners and hold them personally responsible. Now, this is not easily done. If you'll put that fourth and final chart up on the screen, we'll talk about it. Now, as you visualize that screen, on the screen, put a big box around the LLC and corporations like a wall. The creditor's trying to get through the LLC back against the owners, or the corporation, either one. And the plaintiffs in a car wreck case are trying to get through the LLC or the corporation to get to the assets of the owners. Now, this has been done several times in Alabama, some successfully, some not. Freeman, let's talk about how you do that and what you have to do to get through them.
Well, first, it is, like you mentioned, it is very difficult to do. In general, Alabama courts are reluctant to do that because the sole purpose, or one of the main purposes, not the sole purpose, one of the main purposes of setting up an LLC or an LLP or a corporation is to shield the owners from personal liability.
For debts and for accident cases, a most common thing.
Correct. So that's why you're able to do that under Alabama law, and so obviously the courts will be very hesitant to pierce it, and it can only be done in extraordinary circumstances. Now I have a slide that we're going to put up that's going to detail the three ways that you can, or the three aspects that you can argue that you can use to pierce a corporate veil. One of them is undercapitalization.
Yeah, let's ask Rodney to comment on undercapitalization. What does that mean?
That typically means when the owners, when they form the entity, whether it be an LLC or a corporation, they've undercapitalized, meaning they haven't provided the entity enough money to operate on in regards to startup cost and in regards to just normal expenses that they may incur on a daily basis. And so typically when you run into that term undercapitalization, it means when the entity may be operating at a deficit, the owners aren't willing to put additional money in, it's undercapitalized, their only alternative is to borrow the money.
It can also mean that they don't carry the insurance that they should. If you're running a bigger business that tends to have a lot of liability issues and you only carry $25,000, and that can
Yeah, let's put that slide back up so we can go over the other points.
Generally speaking, undercapitalization isn't going to be enough alone by itself to establish personal liability of owners or members or shareholders, depending on what kind of entity we're talking about here. Usually the interactions of the other people that have ownership stakes in the company will also have to be used, which would be abuse of, people abusing the entity itself that causes harm.
Let me give you ask you if this would be a good example of that, abusing the assets of the company. Let's suppose that the owner treats that company's bank account as his own personal bank account, takes money in and out anytime he wants to. Is that the kind of abuse you're looking for?
Sure. There's all kinds of abuse, but that is certainly one of them. If you set up a stack of LLCs or a stack of corporations that are really only there to shield liability, they don't serve any other purpose, then that can be a reason to pierce the corporate veil. And that's also number 2 on our slide, fraudulent conception or operation.
And that means it's really a sham when you've got LLC owning an LLC owning another LLC to create all those walls to try to get through. It's really done for one purpose, and that's to defeat a legitimate claim against the company or the LLC.
It can also be a shareholder or a member of an LLC conveying to that LLC or that corporation a lot of personal assets that don't have anything to do with the business to shield them from
to hide them.
Liability. It could be a divorce. It could be an accident of some kind.
Oh, it wouldn't be in a divorce case, would it?
Well, it could.
I'm just joking. That happens a lot. You'd be surprised. But anyway, that's what they look to, is what you're saying, is they look to those kind of things to determine if the formation of his LLCs is really a sham and not done for legitimate business purposes.
Yeah,
Rodney, do you want to comment?
Another way to say that was if the formation of these LLCs and or corporations are just an alter ego of the individuals that run them, then typically that's an indication of piercing the corporate veil. You should basically treat these entities as a separate third person and conduct business as if they were a third person.
right.
And that's
Put
actually our third one.
Yeah.
Alter ego and excessive control are basically going to mean the same thing. And we have a further slide that goes into more detail. The Alabama Supreme Court has a 3-part test when it comes to excessive control or alter ego of a corporation or an LLC that they use to decide whether a party can pierce the corporate veil. And those 3 things are whether you have complete control and domination by that person, if you misuse that control, and if that misuse causes injury or liability in some way.
Well, I can see from what you've told us tonight that piercing the corporate veil is not easy.
It is not
And
easy.
you can't do it without a lawyer who knows what he's doing. So we got about 30 seconds to go. Rodney, want to thank you for joining us tonight. Again, we ask
Glad
you
to
to
be
look
here.
to our cases, our shows coming up, rather.
And also, if you have any questions about anything we've mentioned tonight, feel free to give us a call. If you know anyone that's had a hip replaced and had any issues or has any questions regarding that litigation, also feel free to give us a call.
Okay, thanks for tuning in tonight, and I hope you enjoyed the show. We will run this show more than once. So we look forward to seeing you at our next scheduled time, 6 times a week. Thank you for tuning in.